If you're watching a finance and business-focused YouTube channel, chances are you've seen The Wolf of Wall Street numerous times. It's a captivating movie that has influenced many aspiring salespeople. However, there's one line that still bothers us years later. In the film, Jordan Belfort, played by Leonardo DiCaprio, famously says, "No, I was following," implying that taking notes makes a difference. But the real Jordan Belfort has admitted that the movie is only loosely based on his book, which itself is loosely based on reality. Many details were omitted due to their association with criminal activities. In this video on Rich in Your Life, we'll delve into how Stratton Oakmont's questionable operations allowed Belfort to earn almost $1 million a week through fraudulent stock market practices. The evolution of stock trading and brokerage. In the past, stock trading was more complicated than it is today. Before the 2000s, people couldn't simply go online and buy stocks. They had to call a stockbroker, who would then execute the trades on their behalf. Stockbrokers often advised their clients on what to buy or sell, and clients relied on them for market information. Unlike today, where stock prices are readily available online, investors in the 1980s had to wait for newspapers or call their brokers for updates. However, as Matthew McConaughey's character in The Wolf of Wall Street points out, nobody can predict stock movements accurately, not even stockbrokers. Despite the uncertainty, stockbrokers earned significant commissions by processing trades for their clients. This commission-based model incentivized brokers to encourage trading, even if it wasn't always in the client's best interest. From high commissions to zero-commission brokers. In the 1990s, it was common for stock trades to incur high commissions, sometimes as much as 2% of the total asset value. Stockbrokers typically received 1% of this commission, with the remaining 1% going to the brokerage firm. Jordan Belfort, portrayed in The Wolf of Wall Street, worked for companies like Investor Center, which operated as over-the-counter brokerages. OTC brokerages differ from exchange brokerages like LF Rothschild, which facilitate trades on public exchanges like the New York Stock Exchange. Exchange brokerages had teams of people on the NYSE floor, executing trades called out by stockbrokers in their offices, who in turn relayed instructions from clients. While the commission-based model led to some unethical practices, such as brokers pushing clients to make excessive trades for higher commissions, the exchange had more oversight over these activities compared to OTC brokerages. Today, the rise of zero-commission brokers has transformed the trading landscape, making it more accessible to individual investors. Regulation and oversight in stock exchanges versus over-the-counter firms. Stock exchanges like the NYSE have strict regulations to ensure fair and transparent trading. They can remove stockbrokers or brokerage firms from the trading floor if their actions harm the exchange's reputation. Exchanges also regulate which companies can be listed, auditing financial statements and conducting background checks on management. In contrast, over-the-counter firms operate outside of exchanges and have less regulation. Companies can directly approach OTC firms for funding, offering a percentage of the funds raised. While some companies genuinely need funding for legitimate projects, others may seek to defraud investors. The difference in oversight means that while exchanges offer more protection to investors, OTC firms can be riskier. Investors should be cautious when dealing with OTC firms and conduct thorough research before investing. Stratton Oakmont and high-pressure sales tactics in stock trading. Jordan Belfort, along with his colleagues, founded Stratton Oakmont, a subsidiary of Stratton Securities, to trade both over-the-counter and exchange-listed companies. Belfort's approach involved hiring brokers to aggressively pitch stocks he had acquired through strategic means. Belfort would first identify small-value companies with a market cap of less than $100 million. He would then ask trusted contacts to buy a significant amount of stock in these companies, creating a buying frenzy. Belfort's brokers would then sell these stocks to unsuspecting investors, claiming significant value increases to drive up demand. This strategy relied heavily on high-pressure sales tactics and misinformation to manipulate stock prices. While Belfort and his team profited from these practices, many investors suffered significant losses. It's a cautionary tale, highlighting the dangers of aggressive sales tactics and the importance of conducting thorough research before investing. Market manipulation and initial public offerings. Jordan Belfort's market manipulation scheme involved strategically buying and selling stocks to drive up prices and then selling off shares before regular investors could, causing the stock price to collapse. His company, Stratton Oakmont, made it difficult for regular clients to sell their stock, giving Belfort's associates time to exit their positions at a profit. This scheme reached new levels when Stratton Oakmont began taking companies public, known as initial public offerings. An IPO is when a company becomes listed on a public exchange, making it easier to raise capital from the public markets. Companies hire underwriting firms to guide them through the process and share the risk involved. The pump and dump scheme in stock market manipulation. In the world of finance, companies often turn to investment banks for assistance with IPOs, where shares are sold to the public for the first time. A successful IPO means all shares are sold at or above the agreed-upon price, ensuring the company raises the desired capital. However, Jordan Belfort and Stratton Oakmont took a different approach, courting companies to use their services for underwriting instead of traditional investment banks. Despite the oversight and regulation of public markets, Belfort devised a scheme to manipulate stock prices using a tactic known as pump and dump. In this scheme, Belfort's associates, or rat holes, would buy shares in a company before it went public. Once the company was listed, Belfort's brokers would aggressively sell the IPO stock to their contacts, driving up the price. This would attract other investors, unaware of the manipulation, who would buy shares at inflated prices. Meanwhile, the rat holes would quietly sell their shares at a profit, exploiting the buying frenzy. The resurgence of pump and dump schemes in crypto markets. Pump and dump schemes, once thought to be declining due to online trading platforms and easy access to market information, have made a comeback in the loosely regulated crypto markets. Unlike before, when brokers hyped up small-cap stocks, today, these schemes are orchestrated by Discord communities and gaming influencers, targeting meme coins in the crypto space. These schemes involve artificially inflating the price of a cryptocurrency through coordinated buying, creating a buying frenzy, and then selling off their holdings at a profit, leaving unsuspecting investors with losses. The lack of regulation and oversight in the crypto market has made it fertile ground for such manipulative practices. In the movie The Wolf of Wall Street, Jordan Belfort's methods of hiding his ill-gotten gains were also highlighted. It's important for investors to be cautious and conduct thorough research before investing in cryptocurrencies or any other asset, as schemes like these can lead to significant financial losses. That's all for today's video on the mechanics of financial deception as seen in The Wolf of Wall Street. If you found this information valuable, please hit the like button, leave a comment, and subscribe to our channel, Riching Your Life, for more insights into how money works. Thank you for watching.